In this example video, we're going to look at review exercise 11.3 and review exercise 11.10 that are both dealing with the double declining balance method of depreciation. So in review exercise 11.3, it tells us that our company purchased equipment at the beginning of the year for $75,000. It tells us the asset does not have a residual value and it's estimated to be in service for 8 years. So they want us to calculate the depreciation expense for years 1 and 2 using the double declining balance method and rounding to the nearest whole dollar. So we're doing this for both year 1 and 2. We have to look at the asset's book value. So when we're talking about book value at the start of the year, it's the asset's initial cost minus any accumulated depreciation at the beginning of the year. So on year 1, I buy the asset on January 1st. I buy it for $75,000. There has been no depreciation that has accumulated. So our beginning book value in year 1 is always just that initial cost. When we're talking about our double declining balance rate, our rate is 1 over the useful life in years times 2. We're doubling it. So that means our rate is 25%. That rate is going to stay constant for us over the life of the asset, except for the final year of that asset's useful life. The only time double declining balance does not use that rate is in the final year of the asset's useful life if there is any type of residual value. That's the only time that would happen. So we simply take the 2, we multiply that, we'd have $18,750 in depreciation expense in year 1. So ending book value, initial cost, minus how much we've accumulated in depreciation. We've only accumulated 1 year. So that means we'd have an ending book value of $56,250. Year 2, ending book value from 1 year becomes beginning book value for the next. Again, our rate, double declining balance rate, does not change. So we simply multiply the 2. And again, they told us to round to that nearest whole dollar. So ending book value, $75,000 minus the $18,750 minus the $14,063, we end at $42,187. So we're going to utilize that same information to look at what happens if we have partial period depreciation, meaning that we did not buy the asset at the start of that fiscal year. So they tell us in review exercise 11.10 that the company purchased the asset on April 1st rather than January 1st. And again, they want us to use the double declining balance method in order to determine our depreciation expense for years 1 and 2. So we know that the annual amount of depreciation expense, if we owned it for that entire year in year 1, would have been that $18,750. We bought it on April 1st, so we have to include all of April through all of December, which means that we've owned it for 9 months. So our computation then, 9 months out of 12 times the $18,750 tells us that we'd have annual depreciation of $14,063 in that first year. In year 2, we know that if we owned it for the entire year, we would have had $14,063 in our total depreciation expense. In year 2, we have owned it for the entire year. However, we have to finish using up year 1 in order to move on to year 2. So that means we still had 3 months out of 12 at the $18,750. Plus, we now have 9 months out of 12 of the $14,063. So that means in total, we would have $15,235 in depreciation expense for year 2 if it was doing partial period depreciation.